Welcome, everyone. I can see many audience members entering the room as we speak. Foundation for the Study of Cycles, Critical Roundtable on Gold and Other Precious Metals. Today is August 23rd, 2022, and we are following up from a very successful Foundation Study of Cycles Market Summer Summit. And due to popular requests, people wanted answers on gold. As do I. With this very precarious, sideways, volatile pattern the market is in, we brought together the best of the best experts from our board and guest speaker too, to answer that very question. So a big welcome to all of our attendees and new members. Yes, we do have more new members on this follow-up session, which is great to celebrate with all of you. Welcome to the FSC. As part of the Critical Roundtable on Gold and Other Precious Metals, this is a live, approximately 2-hour immersion session. We're going to lead off with presentations, 10 to 15 minutes long, with fire shot questions in between, just brief, to keep the flow but engagement going. And then right at the end, we'll have a Q&A forum, which will be led by the discussion that follows the presentations. So 5 speakers. Speaker number 1, Andy Pancholi, on gold price analysis, seasonality, geopolitical risk. Peter Eliades, I'll make a correction here. It's looking at gold ETF, and he'll speak more on that alongside other related metrics using Hurst timing. To follow, Bill Sarubbi on gold stocks and US dollar. Jake Bernstein on the breadth of the precious metals area, specifically palladium and potentially other focus points. And Lars von Thienen, you'll know from our Cycles app featured on the FSC YouTube channel, gold timing in general. He'll look at some a past call that nailed the bottom in gold and what that same analysis suggests for the future ahead. And right at the end, a look at the US yield curve, as many of you will know, is often a lead indication for economic growth or contraction, with potential risk of a recession ahead and what that might mean for safe haven flows back into gold. We'll circle back to that once we start the session. So quick review on FSC membership, especially for many of you who are here for the first time. Regular content in terms of webinars, blogs, all types of different digital media, including the age-old Cycles magazine, which is many decades old and has a long tradition. The recent one just featured about a month or so ago. Fellowship of scholars, scientists, non-professional investigators, everyone involved in the world of cycles. Markets primarily, but everything else too. And then, of course, in this new technological age, we have the Cycles app that allows you to quickly and easily spot cycles. It's a good thing, but of course, you still have to incorporate your own analysis framework, including with risk money management if you're trading. So do use that as best as you can alongside everything else that works for you. The Cycles magazine, this is the recent edition, which I previously featured at the summer event that we held. So I'm just going to give you a high-level reminder on that. Download it, read it, share any feedback that you have. We continue to publish top level cycle research within this magazine. And then, of course, as a nonprofit organization, a big thank you to our members. You are all helping fund the events, materials, and future planning that we are busy in the background with. Remember, there are different ways to support us. Donations, continued support towards raising awareness, contribution of ideas, time, and community. There are many different ways, and all it takes is just a little bit of a stronger together approach for us to continue with the work. And just a logistical point before we kick off, questions best to send through the Q&A so that as your host, I can help field out those questions and make sure they get answered. So do that where possible. And as a test opening question to our collective audience out there, I've switched the usual question, where are we in the market cycle, to what is the stage of the gold cycle and why? The best options I could come up with is bull, sideways, bear, or other. Please share your answers quickly and honestly or objectively in the chat so we could have a quick flavor of what you all think as the FSC collective. Okay, what can I see here? Is anyone? Usually it takes one person to lead by example and the rest usually follows. So whoever that first person is,
so Ron,
type your answer in.
So Ron, I will give you a bottoming.
Thank you so much. Please shoot, Jake.
So in my view, there's a bottom in the cycle happening right now. We need a trigger to get into the bottom, but there's been no trigger to buy as yet. And that's where we are.
Thank you. I can ask the other members of the FSC board and our guest, Peter, if you wish to kick off with top line view, that would be great.
I'm tending to be, let me state first of all quickly that I do not claim to be an expert because I don't do too much work on the metals. But from my projections, I'm tending to be bearish. I have some very significantly lower projections for both gold and silver. And I think it fits in psychologically with the fact that right now, you know, huge inflation. And where's gold? Gold goes up in inflation. It's not going up, folks. So anyway, I put myself down as bearish.
I would agree with that. Bottoming still bearish. That's true.
Others, please. Andy, Bill, Lars.
Well, I'm just about to present once we've started this, so I don't want to give away my outcome on that one. I'm going to hold short right now.
You're going to vote LGBTQT?
Well, I'll do a quick read of what we've received from our audience. Neville saying sideways, Martin saying bearish short term. Agnes is saying, as per my analysis on software, gold will dip shortly and then going upwards. Ron is saying bearish. Stan is saying my work suggests 94-month cycle bottom in October 2023. And Chris is saying bottoming if cup and handle over 12 years, maybe question mark. And I just got some pushback from one of our audience members saying, you gotta say which time frame. Point taken. So please, can everyone say which time frame they hold their view? Okay.
Long term for me.
Thank you, Jake. Okay. And over to our first speaker, Andy Pancholi, FSC board member, gold price analysis, seasonality, geopolitical risk. Andrew Pancholi is the creator of the Market Timing Report, co-author of other information that is on the bio. I won't read it out word for word. Andy, over to you.
Thanks very much, Ron. Sorry, I realized I just cut out your presentation. First of all, welcome everybody. Thank you so much. There's a lot of very familiar names from all across the world. I'm seeing people in Australia, all the way across America and Europe and the Far East. So thank you for joining us. I think you'll find this is going to be a very interesting evening. So let me just kick off here. And what we're going to do is we'll look at gold at this moment in time, August 2022, what lies ahead. And what we're really looking at here is I'm going to bring up some of the key factors in gold. Now, I'm coming across here from a trading, investing, portfolio manager point of view. So this is all about looking for incremental gains, not just in gold, but in anything we do in trading and investing, about managing the risk, looking to get the odds in our favor, putting them all together for good results, and then taking that analysis into trading if it's possible. And that's the whole thing. So I'm going to put together a few bits and pieces and we'll see where that leaves us. So just looking at this incremental gain analysis, the first thing that I want to bring up is we don't have a huge amount of data on the free trading of gold because it's been pegged historically. But just looking at 4 to 5 cycles going back to 75, typically years ending in 4 seem to be the most bullish, and years ending in 1 tend to be bearish. But with only 4 patterns effectively, we would say that this is insignificant. But this is part of the research if you're looking at any other commodities or instruments and so on. I know many of you follow our work, we go back hundreds of years where possible. However, when we move to the monthly performance of gold, we've now got 47 examples, and we can see something very clear in terms of which are bullish and bearish months. And first thing to note is that we're in August here, and historically, seasonally, this is usually a bullish phase. So from July through to September, mid-September, and also, by the way, from November through into January, and then we tend to pull back into February, March. So this is just giving us some overviews. This is sort of the general prevailing weather over many years. And we can zoom in a little bit further, and we can see typically that if we look at this 47 years of data, we tend to see, just look at the blue line here, which is the annual seasonal pattern. Typically, if we average it all out, we're looking for lows round about mid-June, and then really the beginning of August, things start motoring probably into the beginning of September, supposedly. So what we're hearing so far in our investigations and analysis is that we're probably in a bullish period for gold. Then we can look at the decennial patterns. And again, putting these together, 1982, 92, 2002, and 2012, we've got 4 examples, averaging them out. And they tend to see a bottom on the August the 15th and average out on a top round about the 20th of September. So the idea is that, as we saw from the regular seasonality plus the decennial patterns, generally speaking, if you take this trade every year over the last 47 years, you would have made money. So that's the background. But the market's telling us a completely different story. We are seeing a bear market. We are seeing, and remember, this is the only truth. The only truth is price in the market and the market chart. We're seeing lower highs, lower lows. And to make things worse, the 15th of August, which if you remember from the previous chart was the low, actually turned out to be an inversion and a high. And we've heading down. I know we popped up a little bit today, just updated this chart yesterday. So what is going on? There's several factors in play. And well, also just to show, this is the channel that really is in play. And as long as this upper line pretty much holds, or the green line is the sort of median line here, this is what we want to see. And if we were to maintain a bearish market, this channel is fairly critical, even though we've exceeded it once there. So what's going on? Basically, one of the big clues comes in the commitment of traders' data. So this is published every week by the CFTC. And I'm sure many of you are fully familiar with this, but just a very quick overview. When we look at the activity of the commercials, these are the hedgers, the miners, the people who use gold. And typically, as the price of a market goes up, they tend to sell more until they get to a point where there's nothing left to sell, effectively, is one way of putting it. But what we're seeing here is this top line is the price of gold. This bottom line is the activity of the short selling activity of the commercial money. And if we look over here, at this point in time, they stopped selling and got down to a very low level. And that coincided with a major low there. The next time we got down to this level was over here. And that really was the prelude to this bull market here. And then back in 2018, we got down to this level, which is roughly, it's about 200,000 contracts. So they've gone from selling, 600,000 contracts down to 200,000. And again, that there really heralded the beginning of this bull market. But what we're seeing right now is that we haven't got to that level. So this does not support the case for a significant bull market. This is a very key point. This is the smart money, and they are not sub 200,000 contracts right now in terms of the amount of selling they're doing. Therefore, it's highly unlikely that we're going to see a strong bull market in the immediate future. And that's one of the very important points. So coming to the technical side and the geometry of the market, this is the history of futures trading in gold. And we have here an Andrews pitchfork, which I've shown both at the foundation and those of you who follow my work anyway. This was derived from these points, and it caught the exact top there. And this median line is a key line. So what we're really saying is that at the moment, the evidence, the COT data, the chart pattern is heading downwards. Where would we see major support? Well, this green line here, the median line, would be an ideal place. And that then would give us support at around about 1630 and rising. So that could be a level that we might see a degree of support at. And if at the same time, the commitment of traders data shows that we are less than 200,000, the smart money is less than 200,000 contracts short, that could present us with a buying opportunity, as well as, most importantly, providing us with a place to manage risk, a point there to manage risk. And let me just highlight this. What you can see is that we can put the 50% lines in here, and you can see how effectively they've worked for risk management there. So this is a fabulous long-term pathway. And of course, should we see a bull market for whatever reason, be it geopolitical risk or inflation or whatever, then an upside target at the moment would be around about 2260 up here. So that's just an overview of taking the potential trades. So what we can do is we can apply this to a more localized pitchfork to see if this number down here, which is a bit higher than the 1620, holds, and see if the market holds there, tests there, and once it's proven itself, and only when the market proves itself, remember, everything else is analysis, it's all fiction, the only fact is the market. So that's one point that we can manage risk at. Also, we can bring in short-term cycles, and what we do is we cluster them together, and where these histograms peak, we tend to see major changes in trend. We've got a significant point coming up, weeks ending 30th September, 14th October, and 11th November. Now, this is just look at these 14th October and 11th November points, and I'll come back to that in a minute. And there's some shorter term cycles here for daily changes in trend, 2nd to 4th September and 11th to 12th September. But the idea is that if I just head back to that previous chart here, and we look at either the 14th of October or the 11th of November with the shorter term cycles, and then we head all the way back to here. Actually, this is a good place. What you can see is that regular seasonality tends to see a potential low round about mid-November. So if we are craving a long position and the market is down here, is selling off into this mid-November point, seasonally, we're now realigned with the flow. And again, if whatever you use to judge the market indicators, so we use the COT data, etc., if that's indicating the potential to buy, that could be a configuration point there. We also had mid-October, which is there in the 30th of September. So we might see a sort of change in some sort of trend around about the 30th of September. But this is how we put it all together, how we stack it all together. So if we look at put it like that and fast forward back to where we were, the key point right now is gold is in a down market. All the evidence historically suggests that this is the most bullish phase. So what does that tell us? It tells us that actually gold is significantly bearish, because it is not just not going up, it is not going sideways, it's actually going down in its most bullish period. So that suggests the market is incredibly weak right now. So we need to see the chart pattern change and give us some degree of hope to the upside if that's the position we're taking. Equally, of course, in portfolio management, we're nicely set up for a short trade as things stand. So the other thing is, I want to bring in some geopolitical factors. As you know, we look at geopolitics. Now, many of you watched the presentation we did earlier this year on the 6th, 7th of January. There's a few points to bring in here. First of all, one of the reasons gold, in my opinion, and I'd love to discuss this with my peers here later, is that a lot of money has left gold and moved into cryptos over the last few years. So some people estimate 11% of the previous gold money has moved to cryptos. I don't know what the number is, and I'm not sure if there's any clear way of measuring it. So that kind of reduces the effectiveness of cryptocurrencies. One other thing about gold is that on the right here, you can see Executive Order 6102 that was issued on April the 1st, 1933 by President Franklin D. Roosevelt, who basically took gold off the gold standard, and you had to hand your gold in, for which you received $35 an ounce. So gold became pegged there. Now, as you know, I'm a big fan of the 90-year cycle, and that suggests that next year we could see some degree of intervention. I'm not convinced it's going to be in gold. I think it might be in cryptos. I think we see a higher level of intervention there. So that could be what others would call the black swan. Of course, we don't believe in black swans. We just say it's a cycle that nobody else spotted, or it's a longer cycle that we don't have enough repetitions of. So there is a potential threat there of this 90-year cycle repeating. And of course, in Fibonacci terms, we're 89 years away from that right now. So, you know, that threat window is open now. So that's the 90-year cycle. Geopolitical factors. What we did see, I'm just going to take us back to, this is probably as good a chart as any. So this here showed the intervention in the Ukraine did see a spike. So we did see gold react to a geopolitical event. And what we are at right now in terms of geopolitical cycles, we are at a critical week in the Ukraine-Russia situation based on mathematical cycles. And that happens to coincide with the day after tomorrow will be the National Day in Ukraine. And I know several people are vacating Kiev, expecting an escalation in strikes. And there's even talk about nuclear events, which I doubt are likely to play out, but the nuclear cycles are in for this month, as we've discussed elsewhere. The other thing is that we are also seeing cycles coming in the Taiwan and China situation. The escalation there following Pelosi's visit really has played very much into the hands of China. So these are hot potatoes. Now, the 60-year cycle takes us to 1962. We saw a tale of two halves there. High level of Cold War aggression in the first part of 1962, then an escalation as Russia took missiles across to place them in Cuba. So mid-October saw the Cuban Missile Crisis. We have been overlaying the 60-year cycle very closely in the stock market. And I think we are going to see this some similar buildup in October. I think it's Khrushchev then who was in the standoff, and and Russia eventually backed down. But talking to those who were around at the time, including my mother, she just thought the world was on the brink of war. So I think we're going to see an escalation in geopolitical tension as we head into October and the rest of the year, and that in itself could have some repercussions for gold to the long side, especially as we did see the mid-October cycle there and the mid-November cycle. So I think that's pretty much all I have to say at the moment. Back to you, Ron.
Thank you. I'm just going to quickly share two feature charts which we can maybe discuss during the Q&A forum. First one is what's been called the Bermuda Triangle on gold. It's been one of the most hated markets year to date, going sideways with a lot of whipsaw. Big question, what's the trade? And if I could throw that out to the entire board for a forum question when we get to that stage. And second, just to chime in with your geopolitical angle, Andy, which is one of your key focuses in general with the FSC, this crisis spike pattern that gold tends to produce, I mean, rarely, but still something to keep in mind, 1980 and 1973, 74. I know you're looking at more short-term reactions, but it's good to maybe keep in mind some of the bigger ones, how it can move and what the key drivers are back then. Okay, so stepping forward to our follow-up speaker while we work out logistics in the background. Bill, if you're all set up, I'll kick off with the intro. Bill Sarubbi, FSC board member, money management consultant, and Forbes contributor from 1972 to 1990. He worked on the buy and sell side of Wall Street as an analyst, institutional broker, and technical analyst at Payne Weber. From 1990 to 2004, he was with the Abu Dhabi Investment Authority, known as ADIA, where he was a technology fund manager, North American strategist, and member of the Currency Hedging Committee. He has developed his own market analysis software. Bill, over to you, and lucky second time. Hopefully everything should work.
Okay.
All good.
Well, thank you very much. It's nice to be here again. Gold is, as I always like to say, a reasonable probability is the only certainty. And my summary is gold is likely moving higher over the short term. After that, I think you have a very choppy market through next year. I think it's a big trading range. So if you like to trade gold long and short, I think it will be a good market. If you think you're putting gold away as a hedge against anything, I think that will be disappointing. Seasonality is most favorable in September. Price inflation is likely to increase in the face of increasing government spending, and the excess liquidity has to go somewhere. The real estate cycle is topping. We can already, I just came back from the United States, and you could already see that there. And cryptocurrencies have been no safe haven. So as my friend Tony Plummer in England said, cryptos retraced more than 50% of their last rally. That's not a good sign. I think it's going to take some time for cryptos to sort themselves out. So to begin with, I think most of the gold headwind is a dollar headwind. This is a long-term foundation chart. And you'll note back here, you can see my pointer, back there, the cycles all turned up. So I assumed gold was going to break out of this big triangle. Now, if I didn't have monthly up here, if I didn't have dollar, and I didn't have a time scale down here, any technician will tell you that breaking out of a triangle is very bullish. It had a strong move, it consolidated, and it broke above that resistance line, and it points on the DXY to 110, 115, 120. So I think this is the headwind that gold has been facing. So you may be asking, why is the dollar so strong? And I've lived overseas now for 32 years, and I know, especially from the Middle East, that whenever the world seems very unsafe or very unstable, that people go to the United States. It's got the best combination of a legal system. It's got the reserve currency of the world. It's a reasonably safe place to be as compared to other places. And I think a lot of money is fleeing overseas. According to my economic and political cycles, I think things will get more difficult. So you have more incentive to go to the dollar. This is money flows into the USA. It's cumulative money flows into equity by regions. And you'll notice US is number one. So this is what I'm talking about. Note that started at the end of 2020. And this I just threw in. This is the PPI, Producer Price Index, which a lot of people use because it's got a long history as a measure of the effect of inflation. And you'll notice the United States went off the gold standard here. It was August, I think, 71 when Nixon took us off, and then June of 80 when Jimmy Carter signed the Monetary Control Act, which says that the Fed can monetize anything, which means they can buy up all of our mortgages and credit cards, give us cash, and list those assets in quotes on their books. And you can see what has happened since. So there's no restriction on the creation of liquidity. And I think we've been seeing that since the beginning of the year. There's no sign to me that that is going to level off. So theoretically, they could inflate the currency to infinity, which means the other side of the coin is prices could go to infinity. I don't think they will. Now, this is a contrary opinion. This is a contrary opinion screen. This is the inflation rate according to the Federal Reserve database. And you'll notice this comment at the top. At this current juncture, it is hard to believe, it is hard to imagine how inflation could pick up anytime soon. Klaus Schwab and Thierry Malloret, July 1920, that's the comment right there. Paul Volcker, who is given a lot of credit of breaking the back of inflation the last time around back in 82, he died right in here. And then we had James Dines, who predicted the first period of stagflation back in the 60s, said that he saw rising inflation, which would cut purchasing power, and that markets would go down to sideways stagflation. He passed away this past April, and now people are once again using stagflation, the term that he invented, or he wrote about it in his book, The Invisible Crash. And then I had this Bloomberg cover appeared right here. I couldn't fit it on this screen, so here it is. On the next screen is inflation dead. So to go over that again, it's the James Dine dies, Schwab comment, Paul Volcker dies, and the Bloomberg cover, probably more because I don't look at all of the magazine covers. So this is from John Williams at Shadow Stats. That's shadowstats.com. This is the alternate CPI. It's not anything Williams invented. He's just maintaining the database according to how the government used to do it. But of course, they don't like high inflation, so they watered it down. So you get this red line as their official inflation rate, but that's it. The blue line is the inflation rate according to the way they did the statistics years ago, and Williams maintains these. Now that is excessive money supply growth. Annual U.S. money, this is again shadow stats. So you can see that it is not low and it is not going down. And that is the monthly gold price going back to 1800. Now, I'm not an Elliott wave expert. I have a great respect for people who can use the Elliott wave, but it looks like to me 1, 2, a big 3, a 4, and we're in a 5. 5s can extend. So I still think the underlying picture is bullish, but we're getting towards close to some event out in the next 5 to 10 years that is going to bring gold down. Whether it'll be digital currency and there'll be no hope of gold ever backing a currency again, I do not know, but that's a possibility. Now this is the gold seasonality from 1860. This is these bars represent expected return. In other words, if gold is up 1% in the average month of January, and there's a 50% probability of it being up 1%, you multiply 1 times 0.5, and the expected return for January is the highest of all months going back to 1860. And then of course, March is the weakest month. Then you come into the summer period. August in recent years has been stronger. I'll show you that in a minute. September continues to be strong, up about 61% of the time. Now, let me just show you. This is gold seasonality from 69, which is the charts most of us see. And you'll notice January is still the strongest month. September is still strong. August, and this is what I call the bullish period, June up through October 15th. All that weakness in October comes in the second half of the month. So that is not too different from that. For those people who think that seasonality changes a great deal, it does not. So in gold, if the price declines in July, which it did, the probability of higher prices in August are slightly above 50%. But if the gold price declines in July, the percentage rises to 66% in September. So in other words, if gold is down in July, it is up only 50% of the time in August, which is where we are, or 66% of the time in September. And a normal month of September is 61%. So, and that is now this cycle has been a little bit unstable. It is the monthly cycle extracted from my own software. And as you can see, we were coming into a high here, but the high apparently came in early. And this is that cycle, it's this cycle extended out. So as you can see, as we get out to the end of the year, it looks like a very weak November, December. The seasonality at that point is not that strong. So I think this cycle is going to have more influence then. And that is the gold monthly cycle in the year 2023. And as you can see, we usually have a strong January seasonally. So this is up in January, so is the seasonality. But usually there is a real weakness in the month of March, and that comes close to that month. And then a rally. But as you can see, as we get out to the end of the year, we get this dynamic cycle pointing down strongly. Now, the way I work these together is that the dynamic cycle usually holds sway over the seasonal cycle because the dynamic cycle is dynamic. It's based upon data that just came in. I just reran this. The seasonal cycles are static and that they hardly change. Maybe they'll change 50 years out. In areas of, I like it best when they both agree. In areas of conflict, the dynamic cycle is usually the winner. But if this cycle points up in a seasonally weak month, it usually means that the magnitude of the rally is just very muted. It doesn't turn it down. And so I said money would come out of real estate. There's an 18-year real estate cycle. This is from Phil Anderson's book, The Secret Life of Real Estate and Banking. So I think funds are likely to flow out of real estate if you're seeking an inflation hedge. And this runs 18 years. And I remember talking to Phil, and I said, well, back here, I talked to him in New York, and I said, if you add 7 years, 2016 is the next presidential election, which indicates someone who's business friendly would get elected. And then if you add another 7, you got this period of 5 years, and then after 7 years of reasonably rising prices, then you get sharply rising prices, then a real sharp increase at the end. And he and I both agreed the next top should be in 2023, and here we are in 2022. And from the numbers coming in and from the headlines, it looks like the real estate market is buckling already. I was in the Northeast United States. I just got back to Europe 3 weeks ago, and I'm still seeing headlines that are indicating softness in real estate. That money's got to go somewhere. The money that's not going into cryptocurrencies, and I have 2 friends, they're setting up an online 24-hour, we never close cryptocurrency news channel online. And they told me they went to these 24-hour overnight 24 hours straight of crypto with music and champagne and food and live entertainment. And they met a 25-year-old guy with $8 million and a 30-year-old guy who's got $20 million. And I said, well, did you meet any 8-year-old guys who have $20 million? Because there's an old saying that a bubble bursts when too many stupid people are making too much stupid money. I said, you haven't told me you met anybody over about 30 years old who's getting any, who's made any sort of money. It seems they're all just happen to be at the right place in the right time. So I think the cryptocurrencies will not be attractive for inflation hedges nor real estate. So I think the market picks up somewhere around now and rallies by the end of the September to 1800, 1830, but then you hit that dead period in the second half of October that pulls gold and oil down very sharply. It's Bermuda Triangle for gold. And by the year end, I have a modest target of $1,900. So Ron, that's it for me.
Thank you, Bill. I just have some brief fire shot questions.
Yeah.
On the currency angle, which is clearly strong in terms of the inverse relationship with the dollar, and just the extremely strong strength that we've seen year to date. 2 charts. One is gold rising in other currencies with exception to the dollar, so above its 200-day moving average. So I've got the G3 currencies, euro, sterling, and yen. No surprise, these are the currencies that have depreciated the most, yen being a case in point. And then some of the commodity producers and gold producers, I should say, and importers, India. But question here in terms of the currency effect on gold, what's your perspective there?
You're asking my opinion of gold in different currencies?
Yes, in terms of how
No,
much
I
of an
didn't look at
influence. Okay. And then just finally on the dollar, this is a chart I think featured with Elliott Wave International, just showing a potential capitulation phase on the dollar. Are you more of a long-term bull on the dollar, or are there some risk points that you're thinking about?
Well, at the moment, based on the big breakout I showed you in the dollar, longer term, I'm bullish. And the reason is I think there's a great deal of instability that is not going away right away. And I know people in Abu Dhabi stash a lot of money in Europe and in the United States.
Okay, noted. And perhaps a point that audience members can pick up in the Q&A forum in terms of views on the dollar, how that will impact gold, and maybe just the general currency effect in terms of debasement. Okay, so thank you very much, Bill. forwarding on to our next speaker, Peter Eliades, I'll give a brief intro to keep with the timing. Peter spoke at our last FSC summer financial market event as a guest cycle expert. His career began as a stockbroker, appearing as a market analyst on FNN. From 1975 to 2011, his stock market cycles newsletter predicted amazingly accurate stock market highs and lows. Eliades has regularly appeared on Business World, CNBC, Wall Street Week, a nightly business report, and has been featured on Barron's, the Wall Street Journal, Forbes, and Futures magazine. If you would like to learn more about Peter's work, he did feature an interview with Lars von Thienen on our FSC TV channel, and I just saw a recent media hit on the S&P 500 low with Fox News. Congrats on that. So over to you, Peter. I'll let you share screen.
Okay, now I'm cheating a little bit because I wasn't going to start with this slide, but this is the cycle, the foundation for the study of cycles. I have recently, there are cycles that I've looked at before, but they're very pertinent right now, and I have to show them. They turn out to be stock market cycles because this is data. Actually, this data is from the Foundation for the Study of Cycles. They go back to 1789, which is the beginning of the chart. Take a look at this chart, logarithmic chart. This is a monthly logarithmic chart of US securities prices from 1789 to August of 22 right here at the end. You can see very clearly from this chart that the two greatest declines in our stock market history came and bottomed in March of 82 and July of And guess what, folks? Guess where that takes us? I mean, this is only one iteration here. Oh, good. My internet connection is unstable. Is everyone able to see what we're looking at here?
Oh, all good, Peter.
Okay. So guess where this takes us, folks? Well, let's do it in our heads. 1842, 1932, that's 90 years. March to July, that's 4 months. Let's go forward 90 years. 1932, 2022. Let's go forward 4 months from July, August, September, October, November. In November of 2022, folks. Now, here's what I tell people about this cycle. I said, when you see cycle like this, there are three possibilities. One is it doesn't mean a damn thing. And that's very possible. There's only one iteration. We have a great bottom here and a great bottom here. Two of the largest, I shouldn't say of the largest, the two largest declines in market history bottomed March of 42, July of 32. The next sequence in this is November of 2022, okay? So let me show you one more quick thing. Again, I'm cheating here, but I think everyone will appreciate it because these are actually stock things that I think could well spill over into the commodity world. Let me show you this next chart. Okay, look at this. This is one of the more important bottoms in the Dow. Not everyone is acquainted with it, but in 1942, in March of 42, thought it was April, but let's see, is that, it actually is April. In April of 42, a very important market bottom. This is the Dow, monthly chart of the Dow, okay? So, and that, what followed that was 24-year bull market into 66 right here. And then we went sideways for 16 years. So this wasn't a great decline, but it was very important in terms of what happened after. And I have it 1 month later. This is actually on August of 82, because that's where the bottom occurred. But because August was up strongly after the July monthly close, it looks like the bottom occurred the month before. But this goes from April to August. And if we go equal distance into the future, right here at the end of the chart, December of 22. We have two of the longest cycles in market history. And again, one could argue and say, those aren't cycles. There's just one iteration there. That's not a cycle. Well, and you can legitimately make that argument. What I'm saying is, isn't it interesting that both of these two of the longest patterns in the market, one of them leading to a great bull market, the other one leading to a great bull market, are due to resolve in November, December of this year, okay? So I'll leave that and I'll go to my charts that I was going to show you to begin with now. Now, let me talk fundamentals here for about 30 seconds. I am not a fundamentalist. I believe fundamentals have little, if anything, to do with market timing. But from the charts I just showed you and from a lot of things that we're looking at, one can make the argument that it's not inflation that we should be worried about. It's deflation that we should be worried about, okay? And if that's the case, we may well have a situation where many times markets move contra to each other. Usually gold goes in the direction of inflation. Gold gets good when situations that economically get bad. But what if this is one of those situations where all markets act in basically the same way? And that's down, okay? So with that preface, I'm going to show you SLV. This is an ETF for silver. And this just was confirmed this week. This is a Hurst analysis. This is my own software. It was written for me by a brilliant programmer, a German young man who now lives in Dubai. His name is Stefan Scheuermann. And he did a fabulous job with cycle projection software I've been trying to get done for, I can't tell you how many, it's not years, folks, it's decades. Going back to the late 1980s, early 1990s. Stefan finally came up and programmed it the way I wanted it programmed. I'm starting out with this offset because it just gave a dramatic projection, okay? This is a 100 to 110 week offset. That is the offset we use for nominal 4-year projections. SLV, and this is this week right here, okay? This is running in real time, okay? So SLV just closed below the second offset line. The way I work projections is when one line is crossed, either to the downside for downside projections or upside for upside projections, that is what I consider a preliminary projection. The projection is not confirmed until both of the lines of the offset are crossed. Usually in Hurst weekly work, it's 5 weeks, 10 weeks, 20 weeks. So there's no range in weeks. It's just 5, 10, and 20. Once you go beyond that, it's 39 to 40 weeks and 100 to 110 weeks. And that's what this is, 100 to 110 weeks. And the reason you see a big projection box here, and look at this, it's a huge box, is because the upper end of the projection window is showing you where the crossing took place here, and the lower end is where the crossing took place here. These are weekly projections, so they also add on a plus or minus 10% for potential error. But this is, let me give you these numbers here so you'll have them. Again, these aren't completely helpful because it's not silver itself, it's the silver ETF. But this is calling for a decline to between 9.78 and 13.09. And as you can see, just using percentages, that's down from 1762, the current price. So that's the projection on silver. Now let me go back here and show you how this works. These are the offsets here. I right click on the offset and then I can choose the next offset. We'll look at a 39 and 40 week, okay? This is 39 and 40 and there's nothing in real time for us to work with here. The only other thing I would look at is very short term for this upside projection that we see right here. So as you can see, there was a little upside projection here. Here's the green box. That's the upside projection. We slightly got above it. Now the next one is going to be interesting because that gives us slightly higher projections, I believe. Here we are, okay? So this is now the upside projection in the ETF between 2008 and 2083. But I would caution you here, look where we are this week. If we get below this offset line, this projection will be invalidated, okay? So, and the median, I would say, for the offset line is around 1732. So if you want to check at the end of the week, look at SLV. If the midpoint of the week is below, let's say 17 and a quarter, then this upside projection has been invalidated. And when you start going to the longer offsets, there's nothing there. You've got 2, 3, 4 weeks before you can get a higher projection here, okay? We go out for the next longer one, 20 weeks. Look at this. This was a perfect projection to the downside. And that's why from this area, you start to look for upside movement, even though at the same time this happened, you got the first one we looked at. No, actually, this is 39 to 40. You got almost at the same time the projection with a 100-week offset. This is a dramatically lower projection. Now, windows aren't usually this big. In fact, let me do this. Let me go into my parameters while you're watching. See, it's a projection margin in percent. That's a margin of error. I'm going to change that to 0 while you're watching me in real time. And notice how that changes the projection right here, okay? So what this is telling us is this preliminary projection has been given right here. It calls for 1143. This secondary crossing will not be registered until the end of this week because the week has not closed yet, and this is a weekly chart. So unless we get a fabulous rally the last 2 or 3 days of this week, this is going to be confirmed here, and that's going to widen the box to the downside. So that's what silver looks like, dramatically lower projections. So don't ask me when, because I learned a long time ago. I found the Hurst book on a coffee table about 60 years ago. And I love cycles and I love time cycles, but I've found with the price projection cycles, they're a lot more helpful for me because they give me price. I'd love to have both price and time. I'd love to be able to give you a time resolution for when this might happen. The reason I showed you the November, December things is that something dramatic might be afoot here. You saw those cycles. I mean, the long-term one going back to 1842, those are the greatest declines in market history. Are we approaching something like that where we're going to get this incredible move to the downside in just 3 or 4 months? I'm not predicting it, but I'm telling you to keep your eyes open. Okay, let's go to GLD. Here's GLD, and it's much the same picture here, okay? GLD actually has been confirmed to the downside. So this is one of the downside projections in GLD. That's ETF for gold, 147.70 all the way down to 126.67. Now, as I recall with gold, there's also a 20-week offset. Yeah, this one right here, see? And because I took away the plus or minus 10%, it just gives us the number, 146.55. We're currently at 16 and change, or 162.77. So we're talking about, it's about a 20% decline predicted, okay? That's off the top of my head. So there are 2 cycle offsets that are predicting significantly lower prices in both gold and silver. And again, if you ask me, well, that doesn't tell me when, you're right, it doesn't tell me when. But if I know that these projections are in effect, then there are only 2 possibilities. Once a projection has been given, it's either met or invalidated. How is it invalidated? You climb back above the offset line that generated the projection. So if in the next month or 2 or 3, we go down a little bit more or even sideways or even start up immediately, this projection remains in effect till or unless these lines are penetrated to the upside. So two possibilities: beat the projection, invalidate the projection. Okay. So that's what we're looking at in terms of gold. Now, the very short term, let's do the same thing and look at the shortest offsets here. Okay, and this is interesting. We actually, this week, we're going to get a very short-term projection to the downside. You can do this by eye, you can visualize it. It's not registered yet because the week has not closed as yet. But you can see by eye, it's going to be down around here somewhere. It won't be the new lows. It's the next one we're interested in because that's the one that gave the upside. And see, it's given the same thing here. This is an upside projection on GLD to 174.57. Okay. And again, we don't have the plus or minus 10% in there. We usually put it in, but I wanted to get rid of it to do away with any confusion with any really big boxes. So this, I don't think this is going to be confirmed. I think we have a good chance of invalidating this upside projection, but the market doesn't give a damn what I think. It does give a damn about the projection stuff. Let me show you one more thing. How what this I'm crazy about this software and I'm promoting it because we had been leasing it to TradeStation people, but they've stopped third-party applications. Okay, so this is show statistics. You say, well, how do I know if it's been a reliable cycle? Well, you go to show statistics and you go to look at the statistics, and they're not very good for this offset. The downside projections, only 15 out of 41. So this is not a downside projection you would count on. Let's go back to the longer offset and look at that statistic. No, we don't want that. Okay, let's look at the statistics of this. So we simply right click on the line, show statistics, and here we go. Look at this. I mean, it's impressive because it's 100%, but there are only two projections. So not what you'd call statistically significant. But the downside projections on this long cycle have been 2 for 2. And that's not counting this one because this one has not been met yet. So this is something we put credence in. And with that, I notice I'm running 15 to 16 minutes, so I'll give up the lectern.
Thank you, Peter. As always, live and very timely. We have a question coming in from Mark. There has been an interesting series of movements this year with silver, gold, Dow, E-mini, S&Ps. Have you done any overlay with silver, gold, and the Dow? A very interesting look, perhaps.
No, I have not. I have not done any comparative charting between those elements. But as I said earlier, it would not surprise me, even though they tend to move contrary to each other, it would not surprise me at all to see both of them go down significantly into the end of the year.
And then just a follow-up question, what is the shortest daily cycle that you would consider?
Well, if you want, I'll go to the daily chart and I'll show you, we'll do SLV here. On the daily chart, the offsets that I look at are right here. As short as 1.75 to 2 days, okay? And so that's basically about, well, I shouldn't even say that because I don't want to take too much more time here, but one of the other charts I look at is, I call them hourly charts, but they're 65-minute charts because they fit equally into the day. This one happens to be the S&P. So as you're looking, you can see that S&P projection as we're looking at it. This is an hourly chart, and on the hourly charts, we go to as small a cycle as 263 to 3 on the hourly charts. So let's put gold in quickly here and see if there's any short-term thing showing. This, I can't tell you how excited I am to have this software, folks. I've been working on this for longer than some of you have been alive. And to have it finally here in front of you and useful, and especially with the statistical data that you can cause to pop up, you know, at any one of these offsets to test them out. It's just fabulous. You notice I'm doing the old kill time here, waiting for the chart, because there are so many calculations done with the chart statistically and projection wise, depending on what period of time you're charting. Sometimes it takes a long time for the chart to come up. So we'll wait for about 10 more seconds. If it doesn't pop up here, then I'll turn it over to you guys so you can go on from there, because I don't want to hold up the train here. 5, 4, 3, 2, 1. Okay, it lost its chance. I'll give up the microphone, Ron.
Thank you, Peter. Great session, and look forward to bringing you back in on the panel discussion coming up shortly.
Thank you.
Okay, and just gonna. Oh, actually, just as we speak.
Can they still see it?
Yes, it's live
Okay,
on the
so
screen.
I mean, this is a shorter projection right here. This offset is on an hourly basis, it's 42 hours. So it's the equivalent of a 7 to 8 trading day offset. And this projection was given back here, and we obviously met it. And now I'm not going to go to a longer offset because it'll take too long to come up again. Just want to give you an idea how the software works.
Thank you, Peter. And just to build on the point that Peter made at early on, deflation and what happens when a cliff drop basically event takes place. This is a chart just showing relative performance year to date. And as you can see, when the forest catches fire, the aim of the game is to look for the least burnt tree. And that is currently US dollar and gold only just. Dollar is actually holding ground better. So deflation at play and maybe more to come. And the 60-40 portfolio has taken a big hit. You can see the blue and the red line there significantly down. So these are reasons that people are considering gold or just safe haven demand in general. We can maybe take up that question in the forum. I'll also invite members of the audience to maybe add further questions on this. Okay, now our next speaker, Jake Bernstein, who will be looking at the wider precious metals area. And as an intro to those of you who are aware of Jake's work over the decades, or maybe new as new members, Bernstein has been publishing Jake Bernstein weekly futures trading since 1972 and trading futures and stocks since 1968. His forecasts and opinions are quoted regularly in the financial press and on financial websites, including Wall Street Week, CNBC, JAG, FN TV, and webtv.com. Bernstein is a consultant for investors, traders, industry, financial institutions, brokerage firms, and commercial firms. Traders, money managers, and hedgers, both new and experienced, subscribe to his market advisory service. Jake, over to you.
Okay, good. Thank you, everyone, for being here. Thank you, Ron. Thank you, Peter, and everyone who's doing such a great job. I appreciate that. And one more thing, just let me do one thing here. So here we go. One small change on my screen here. Okay, so let's go. My work is very simple. I made my first trade in the summer of 1967, actually, and I've been trading ever since. I'm a real trader. I trade what I teach, and I teach what I trade. I have nothing to sell you except a few ideas today, which I hope you will embrace. I don't do price projections. I do simply buy and sell when the time is right. I use a trading model I call setup, trigger, and follow through. So every trade or every investment that I make must fall within that model. So in the big picture, cycles, seasonals, these are all repetitive patterns. So they fall into the first category of setup. A setup must have a trigger. Trigger is what people will call timing indicator. And follow through would be how you manage the trade. Peter, I think Peter's microphone is on. So the third part is how I manage the trade. I need a profit target. I need a statement of risk, and I need a way of maximizing the profit. So let me begin by showing you a couple of pictures and the usual disclaimer. So if I were to go, for example, to gold and look at the big cycle, and by the way, my cycle's work is nothing compared to what you'll see from Lars. Lars is the true cycle master. So based on my work, and it's not a perfect cycle, we were due for a cyclical low a few months ago. So now that puts me into setup mode. That doesn't mean we'll bottom right now. I think you all understand that. I'm simply looking for a trigger, which people would call a timing indicator, to get me into the market. I will show you that momentarily. At the bottom of the screen, I have a proprietary indicator, which is small trader sentiment. In other words, we assess the opinion of the small retail trader, the trader most likely to lose their money. When the small trader is very negative, we usually bottom. When the small trader is very bullish, we usually peak. It's a leading indicator. So putting two pieces of the puzzle together right now, gold is due for a cycle, I should say, overdue for a cyclical low. The small trader has been very negative. That is the picture we look at right now. We'll go to the next step momentarily. If I look at the seasonality of gold, which has been covered adequately, more than adequately by previous speakers today, we see that in September and beginning in August is when we have the most bullish seasonal period for gold. And this holds true for silver as well. But I need more than this. I need specifics. So one of my favorite trades is what I call my birthday trade. I go and I do a search the entire month of September, October, November, December, and find me those trades in gold which have specific entry and exit and percentage accuracy. So for example, buying February gold futures, close of trading September 16th with an exit of September 25th, you will agree a very short-term trade has been right 74% of the time. So this is what I call my birthday trade, because my birthday is September the 20th. And I do this trade every year, win or lose, I do it every year, and it's never perfect, but it does produce some very big profits. So that is the history of gold as far as I'm concerned, in a purely objective way. Other than that, if I'm looking at the bigger picture, I need a bigger chart. So here is my chart on gold. If I'm looking for a big move on gold, I'm looking at a weekly chart. This is a weekly chart with my indicator, which I call expansion contraction. As long as the market is expanding its range, we're in a bull trend. As soon as the market begins to contract its range, the indicator switches over to red, and we don't take the long side anymore. We take short positions at resistance. So this is the current situation on gold, bearish. Doesn't mean it can't turn bullish. Obviously, you know that. But for me, it's not about international events. It's not about politics. It's not about Uranus. It's not about psychology. It's all about triggers. No trigger equals no trade. So even though I may be long-term bullish on gold, I am not a buyer at this point in time. I'm waiting. Let me follow that up with another piece of information. Here is the similar pattern in the gold GDX. So I'm looking for that to be a buyer. But again, no specific buy triggers. No trigger equals no trade. How about this? A similar chart, seasonality on silver. So we are coming into the most bullish time frame of the year on my work in silver. But again, remember, this chart is a setup. It doesn't tell us anything without timing. There is no timing yet on silver. How do I know that? Very easy. Here's my silver chart. So as you can see, everything I do falls into those three buckets. And the third bucket, risk management and profit maximizing, itself is split into three buckets: stop loss, profit maximizing, and follow through. So this is the silver chart. And again, the current trend remains down. If and when that trend changes, I'll be a buyer. Until then, I have no view on silver other than to say it's in a bearish trend. Let's look at another one, because I want to get to what I do think is much more important. If I were to pick any of the metals for long-term moves or big moves, it would be either of two: palladium or copper. So I'm not that interested in gold right now, but let me show you copper. This is a cyclical chart of copper futures showing the big cycle right over here and the smaller cycle within the big cycle. As you can see, a double cyclical low is due over here, and we did follow through very handsomely to the upside. A smaller cyclical low is due in about 6 months. Therefore, I think on the bigger picture, we want to be bullish on copper. But here is the most important part. In Andy's presentation, he talked about commercials with the Commitment of Traders report. I am only interested in one aspect of that report because it has made me the most amount of money. And that is the net positions of commercial traders. Commercial traders being specifically end users, in other words, manufacturers and miners. If you look closely at every spike in green, these spikes mean that commercials were net long the market. It doesn't mean that every commercial in the business was long the market. It simply means the net, the balance was long. So as you can see, commercials are taking advantage of the current decline in copper to be buyers. And as long as commercials remain net long the market, this is a very bullish factor for me, and it falls into the category of a setup. So I'm waiting for a trigger in copper. The last trigger in copper we had occurred right over here. You can see that commercials were big buyers before the big move. And that gave me the opportunity to buy Southern Peru copper, which I will show you momentarily. Looking at a closer chart, this is the current situation in copper. You will find that if you have a longer term position, contrary to where the commercials are, you will find it very difficult to make money on the short side of the market. The long side of the market is where I want to be, and you will notice the correlation. Large commercial traders net long the market, small trader sentiment, the lowest it has been since here. And if you take some time to look at these charts, and I'll be glad to provide the PowerPoint, correlate the sentiment, small trader sentiment lows with lows in price, small trader sentiment highs as a leading indicator of highs in price. So copper is my choice. And then we go to the copper chart, Southern Peru copper, Southern Peru copper, which is shown here. And again, waiting. So we are on hold. We're waiting for an opportunity to buy. And that opportunity will come in the form of a trigger. Let me talk briefly about triggers. A trigger can be any timing indicator you want, something that's been working for you. The open-close relationship, the relationship between the 20-day moving average and the 50-day moving average, and so forth. These are not historically very accurate, but there are many timing triggers such as divergence that will trigger these moves highly accurately. And I will say one more thing about Southern Peru copper. It yields over 8%, which is very interesting. So copper would be my number one play, waiting for an opportunity to buy. Let's go to the next chart. Palladium. When you look at the Palladium chart, you will see something that has never happened before. Right over here. This is the largest, longest buying streak by commercial traders in the history of Palladium. It has never happened before. So not only have producers and end users been hoarding Palladium and taking delivery on futures, but they've been doing it for a long time. This is one of the most bullish indications I've ever seen, and combined with the lowest small trader sentiment ever at the end of 2021, this is a prime opportunity for me to look for places to buy Palladium for an explosive move, most likely to new all-time highs. And certainly the fundamentals for that are in place because most Palladium comes from Russia and Soviet Union. And that is an important factor right now geopolitically, but I don't concern myself with that. I'm simply looking at what's happening, and this is really, truly incredible. Let's go to the next slide. Here's a picture of it, and a bigger picture of it. And again, this has never been seen before in copper, in the Palladium, so you might want to take a look at it. It speaks very loudly to me. Let's go to the next slide. Palladium ETF, waiting for an opportunity to buy. And if you're not clear on what this new indicator means, I will provide the foundation with some written material on it so that you can go to the foundation and get that from. Let me show you another one. And this one is very intriguing. The symbol ticker symbol is SPPP, which is a combined ETF, Palladium and platinum at a very low price, waiting for a trigger. And again, no matter how bullish I am on this market, on both of these markets, I'm waiting for the opportunity, and that has not come as yet. So timing has not fallen into place. Now I'm going to end with a very interesting question. Why would it be that in a stock index like the NASDAQ, which has been basically going down for the last few months, commercials have been net buyers. And even to this day, they are net buyers. This is very intriguing because for those who are bearish on the stock market, this basically says to me, don't be bearish, be bullish, because this chart is predicting new all-time highs. I never think about what could make that happen because I have a very creative imagination, and I don't want my imagination to get in the way of my intellect, whatever intellect I have left. This is the Russell. Notice the largest amount of buying we've ever seen in the Russell. So even though the market may be going down, commercials are taking advantage of it to be net buyers again. And this is the, let's see which market this is. One moment, please. This is the Dow Jones. And again, see all that commercial buying activity. Let's go to the next one. A close-up look at platinum. Notice again, look what happened to platinum futures after commercials went net long for the first time in many, many days. Very interesting chart. And at the same time, you'll notice the small trader was quite negative. There's the juxtaposition for you. Here is the Japanese yen. I'm showing this as an aside because I want you to see this near perfect cycle in the Japanese yen versus the US dollar. Look at that. You can't find cycles this good. And what do they say? It says the long drought, the long-term bear market of the yen against the dollar is coming to an end. Expect a significant move to the upside, but wait for a trigger. Notice the juxtaposition. Cyclical low, commercial buying activity, small trader, very negative. And last but not least, here's the platinum chart. There's the cycle again. And one more that you may be interested in, even though I know this is supposed to be focusing on metals, I want to give you an opportunity to come back here 6 months from now and say, that little guy was right. He called the bottom in cocoa, and here it is. But what I see here is for the end of this year, a significant low in cocoa. Commercials have not started buying yet, so things are not in place as yet, but be prepared. And that is what I have for you. And if you have any questions for me, I'm available, Ron.
Jake, great presentation as always, and loved the on-point reference to the trade setup and what it takes for these trades to activate. And there's a question specifically on that in terms of Palladium.
Sure.
What's the best way to trade it, and what would be your educational kind of guidance on a strategy setup?
Unfortunately, the options in Palladium are limited. You can do the futures, which are a really scary market. They will move $10,000 plus or minus in one day. You can do PALL, Palladium ETF. We can do the Platinum ETF and Palladium Mix SPPP. We can do the Palladium ETF the Platinum ETF by itself, PTLM. And of course, we can always do bullion and coins and ingots and so forth, but those are the only good ways.
An interesting index you had there on Palladium and Platinum, and I put in a link just there for the FEC audience about a potential substitution effect due to the geopolitical tensions going on with Russia.
Correct.
I mean, do you see an interesting kind of transition on the chart?
Yeah, it's very interesting. You should mention that, Ron, because the end users had to figure out a way to transition away from Palladium because of their concern that Palladium supplies will be cut off by Russia. So Platinum also has potential, and certainly Platinum is one of the most hated commodities right now. So it's a good contrary opinion indicator.
Thank you. And I just have a final one about a really important point you made about traders and the net effect. It's the chart on silver. We had a brief exchange on it just at the start. If I just share screen just for a second, just for those who are watching the same chart, it'd be good to get your read on this. Just 1 second.
You want me to stop my share?
Oh, I think it should be okay. Just 1 moment. I should be able to share screen now. Yeah, and let's, okay, here we go. So published by Elliwave International, it just shows net short on silver, first time since June 2019. So it's a recent historical reference. But what's your read on this and any guidance?
Silver is cheap. That's the best I can say for it. I have no indication whatsoever to buy silver. It certainly could happen, but for me, it's all the same. It's a market of commodities, not a commodity market. If it triggers and it sets up and so then I will buy it. Otherwise, I'm not that interested.
Thank you. And just following up to our presentation from Jake, I'll now introduce our next speaker, Lars von Thienen, FSC board member, who will be discussing gold timing and a reference right at the end to the US yield curve and what that means for economic contraction, volatility, and potentially safe haven flows. Lars is the founder and CEO of a German-based knowledge management company. Lars von Thienen invented the standalone desktop search and knowledge management app. Coding software since childhood, von Thienen has supported leading German DAX companies in developing their digital and business strategies. As a large-scale project and IT manager, he develops algorithms and software for cycle recognition at when2trade.com and has published 2 books on cycle analysis. Appointed by the Minister of Justice, von Thienen has been working as a commercial judge for over a decade. Von Thienen is based in Germany, and you will see him regularly on the FSC YouTube channel. Please continue to watch, and if you haven't yet, now's a good time to start. Lars, over to you.
Yeah, thank you, Ron. Thanks for having me here, and it's always a pleasure to be in this group. And what I really like is to see all these different methods and frameworks coming together. I think we see that there is not just one approach to cycles, there are different approaches, and I think that's key topic why I'm also glued to the screen for the last hour here. But thanks for the introduction. I want to share the cyclic view on gold on a short-term time frame. So I want to look on the daily cycles. So for the rest of the year, based on the daily cycles model. And before doing that, I want to first say I'm talking about dynamic cycles. I think Bill made this, brought this topic up already. So what we are doing here every Monday and what I'm now sharing is a kind of model where we try to detect the current active cycles, which are due to the variation of cycles, they are not static. So we need to reassess the current status quo of time-based cycles in the market. So it's about timing, time cycles, and these time-based cycles can vary over time. So, and this is what we reassess every week, every day, every hour, whatever time frame you're interested in. We use digital signal processing techniques to do this job, and that's where the charts are based on, which I will share now together with you. So here we are, and I want to recap from June. So everyone is invited to join the Monday Cycles TV show we are doing from the foundation. And there is often the time when we will review commodity, gold, silver, and different markets. So we did this in June, we did this in July, I'm doing this today. It's free, and we reassess the dynamic nature of cycles. That's also the important part. As yearly cycles or seasonal cycles, this is a static cyclic model. You don't need to review it every week, but you need to review dynamic cycles. So therefore, that's also the purpose why we need to review the model. So it's not a static model like Hurst or seasonal or yearly cyclic models. Going back to, and everyone is invited just to review the longer term session we did on 6th of June. We discussed gold in this session. And we discussed the question, I think we were trading at 1,800, something like that. What's the next turn for gold? And we did exactly this projection, expecting at least a short-term bottom in July. So at this point in time, and this model is still valid. So that's also the point I want to refer to that, not just because we did this ahead of time, but this cycle is still valid. So what you're seeing here is, I think, the 110-day cycle, which we discussed there. We updated it just 3 weeks ago. And it's the same cycle. So this 110 day cycles, which have been projected in June to bottom in July. And this was the point where we arrived here 3 to 4 weeks ago, at least from a timing perspective. You can review these sessions on YouTube where we discussed how or why we selected this 110 day cycle. So in the right side of this chart, you see a list of cycles. So that's always the situation when you use digital signal processing, that you will be presented with a list of different dynamic cycles which are currently available in the data set or in gold. And then you need to have a clear method which cycle to pick from this list. And there's a very objective way I always repeat every week. So this is no secret. And this was here the reason to pick the 10 days cycle. And this is where we are now in this cycle. So this is at least the current situation. We bottomed here right on time. So we have been expecting this point in time since June. Yeah, so that's the reason I recap this analysis. We from a timing perspective, we are exactly at the situation we are waiting for since June from a timing perspective. And you see here in the upper chart, this is now a composite model of two most prominent dynamic cycles which are active. It's still the 110 day cycle. And there's a second dominant cycle, which is important. It's the 211 day cycle, which is, if you compare these two cycle length, there's an harmonic relation. So similar to a multiplier of 2 or roughly 2. And we're talking about days here. And if you overlay these two cycles, that's the composite line you see here, which is running until the end of the year, daily cycle model. And that's also important for dynamic cycles. The length of the most important dynamic cycles is stable since June. So sometimes you have periods where the dominant cycle or the dynamic cycle fluctuates in regards to length or amplitude. So it's even the dynamic detection is very unstable, doesn't give you any reliable results. But if you follow every week or every day and reassess how the dynamic cycle changes, and there's just a slight change in the cycle length, then you have a very valid projection. And this is what we are seeing since June presented here. So this model, which we see since June in the markets, which now has brought us to the low in the market here mid-July, seems to be on time. And this is what we are expecting now moving forward into the end of year. I think the cycle speaks for itself. So from the short-term daily model, we should expect an upturn until the end of the year or in the period of December. And then from the short-term model, we cannot project any longer. I think this is similar to what Bill also presented, so that we could see another spin into the end of the year, but dynamic cycles cannot be endless projected in a long-term view. So we cannot use this daily cycle with 110, 210 day cycle and project for 2 or 3 years, because the purpose of dynamic cycles is they are dynamic. So we need to reassess the dynamic nature when we approach October, November, December. So that's the reason the daily cycles cannot predict a long-term situation here. Second, which is important to understand from this model, we do not project price targets here. So that's important to set this in context also to what Peter showed us. He's using these price projections based on the Hurst cyclic length model. This is just a timing model. So even though it seems like this do project any price targets, it does not. We are just interested here in the points in time when the major cycles turn. So here, which is the main turn then by end of the year, and the one we have now currently in the books by mid-July, which we have seen here. So it's a little bit unclear what's the readout for the October-November period, because it shows we might see an interim top, then maybe another short-term a bottom here, and then a follow-up rally into the end of the year. However, this is just timing, so we don't know where the price targets will be. We can even see lower highs and lower lows, as Andy showed us from the long-term technical point of view where we are in these markets. But from a timing perspective, it would then be still valid, because what we're seeing here is a detrended model. So I just try to put this into context of the different presentation, the technical model, a price target model, and a timing model, not a long-term model, short-term model, what we're seeing here. So that's at least the current situation if we look into end of the year, and would be interesting, even if Peter showed us the long-term bearish price targets, maybe we have looping projections into the November period. So that's what I really would like to discuss with you, Peter, then once we do our next session here. But then we can get into alignment from the longer term perspective. Maybe end of the year, we will see a key top in the markets, which will then stand out for a bear market to follow. But we need to revisit the longer model. That's the daily gold cycles model here. And you're invited to follow the weekly session we do I will update this model if there is any news in our Cycles TV live every Monday. And this chart is made by our Cycles application we provide to every member. So I think we have lots of new members also coming in. So you are also invited. You can rebuild the model, which I'm showing here, with our own application we offer to you as members. So at least we eat our own dog food. It's nothing magic here. Every member is able to rebuild these models here and discuss this moving forward. Okay, so let's have the same look on silver. This is now silver, and we have been running the same digital signal processing algorithms on silver to derive what are the current dominant cycles in silver. So the cycle, and then we have selected the two cycles based on the standard procedure with the most dominant cycles. And surprisingly, we see the same dominant cycles also in silver. So you see the length is slightly different, so not 110 and not 211, so slightly changes. But I would call from a nominal model, it's the same length. So it doesn't matter if it's 110 days, 103 days. It's from a nominal cycles length or from a timing perspective. These are the same two cycles, which also can be detected in silver. Maybe not surprising, but anyhow interesting that they are dominant. So here to underpin the timing points here, I've just, this red lines are just drawn by hand to see that we are not interested in the absolute movement of the composite curve here, maybe which can be seen here at the point end of 2020. But the relative low in the markets, it's quite obvious here. So you just want to highlight that we are talking about timing, not absolute price movements, which are projected by the cycles curve here. And that's where we are also using silver in this daily cycles model, looking up to the end of this year here. So this is also a short-term projection here, which is here somewhere November, December here. Same timing, so it's now we are entering an interesting period for the next 2 to 3 months. It's not quite clear from the cycles how to position here. We see also some maybe a sideways phase until for the next weeks, and then maybe a major key top, relative key top, not an absolute top. So we can stay in the longer term technical downtrend, but a major top here expected for end of the market. So silver and gold short-term model daily are in alignment. They speak the same language. That's also important. We often see conflicting cycle analysis, which is not good to trust it or to use this information. But here, gold and silver, they have the same cycles, the same timing information, at least until the end of the year. So that's the daily perspective until the end of the year. Now you might ask, what about the longer term picture? To be honest, the time-based cycles do not give me a clear view right now. So I've been running for sure on the weekly model, the time cycles and the digital signal processing. But currently we have the situation, there's no clear answer. There's not one or two dominant cycles on the weekly model, which is consistently stable. Therefore, I'm not comfortable with sharing any long-term cycles model because there's no clear dynamic weekly cycles model here right now. So that's the simple answer. And that's the situation we are confronted as cycle analysts very often. There's often the situation where there is no clear answer. So on the short term, I'm confident sharing this model. On the long term, from the time-based cycles, it's not easy. Maybe then we have the price cycle targets and the longer term technical situation the other colleagues refer to. But setting this into context, so the last point just on this topic here, and I want to make it very short because it's a little bit off topic, but it could be related. I think I need to move here. It could be related to this point here in the chart, because this is today. This is where we are today. And you see here from the cyclic model, it's indicating a turn here in the cyclic model. And these turns in the past, here number 4, have been proven out to be quite interesting on this curve here. So that these have been turns in the past, so going back to 1973. So this is a long-term model. In this case, using the US Treasury yield curve, but spread here. So we are using the 10-year minus the 1-year US Treasury, which is then a spread, which is displayed here in blue. And we currently have an inverted yield curve, which is a very special situation in general. Nothing to do with cycles in special, but it's a very interesting situations we have currently out there from the situation of the yield curve. An inverted yield curve has special meanings. Often it's a leading indicator for very, very bearish economic market scenarios, a leading indicator. And I've shown you just on top what these situations when we have first an inverted yield curve, and second, when the cyclic model in the US Treasury spread yield curve change. So this is the cyclic model here down below. So 2 factors. First, inverted. So we are below 0. Yeah? Inverted means the 10 minus 1 is below 0, which is not often the case. And second, it follows a cyclic model here. And these situations are marked here just briefly. First point we had 1973. Markets dropped by 50%. Second point here in 1980, markets dropped 30%. Here, the year of 2000, most of us will remember, markets dropped 50%. The year of 2007, the next point, markets dropped another 50%. And this is where we are today. This is where we are today. This is where we are in the cycle model here. Same situation. If this cycle repeats, this confirms the bearish price targets, which Peter Eliades was anyhow talking about the global markets. However, related to gold, I'm not sure if this then underpins the safe haven view and maybe gold can be another place to jump to, or if we see that everything goes down, and this from the daily cycles could then start in November. So I don't know yet. We don't know yet. I just wanted to share this important cycle. I did a long-term review this Monday in Cycles TV, so you're invited just to review the session yesterday on this model here. Could be interesting if gold, safe haven, we see this is not a short drop in the markets. This is a real negative scenario for the markets based on the inverted yield curve and the cycles model, which could, which is underpinning at least a cyclic upturn in gold maybe until end of the year. But that's it. That's my take on gold and cycles right now.
Thank you, Lars. Great demonstration of cycles in action using the FSC Cycles app. And I loved the overlay with each of our speakers in terms of what their views were and how it ebbed and flowed in terms of the different ways that we analyze cycles. There's a question here from Mark. seasoned technician and FSC member. Would you kindly explain how you fit short-term model within the context of a long-term model? I know you touched on this, Lars, just now, but just for further clarification,
Yeah.
Mark is saying he's run some weekly cycles using the cycle finder. Seems that 246 weeks is strongest with the highest Bartel score, and is bearish until next fall. What's your take?
Yeah, the key topic is that I think the long-term model is not stable enough. I'm not sure if if you can see me right now. Just let me know. So the weekly model is not stable enough that I would trust it. I see similar cycles. However, if you go back into the past on longer term cycles, they are not as stable as the daily cycles have been, which I've been using. And that's the key reason. I don't have confirmation at this point in time that the short-term and long-term cycles are in alignment. Bill Sarubbi touched a little bit on this topic earlier. So when he said that the seasonal or the static cycles model can be in alignment with the dynamic cycles model or in disagreement. And then we have conflicting situations. This is what I see right now. At least I have no clear signal on the long term. So there's no conflict, but I have no clear picture. And that situation, I would not trust this analysis. So that's the reason I do not share it. So the weekly is not giving me any clear timing information right now.
Thank you. And on that point of trust, a conversation we had just recently on currencies and the dollar index, Andres is asking that very question on the weekly cycles. Any sense of reliability or even cycle timing?
For the dollar?
For the dollar.
Yeah, I cannot speak about that. And to be honest, on the Forex markets, timing cycles do not work very well right now. So timing cycles, digital signal processing, for sure, there's the price cyclic model from Hurst, which Peter showed. There's the seasonality, which might work. There's a technical analysis. I'm just referring to digital signal processing, time-based cycles in Forex markets. You can't answer for one specific currency. If you want to go into the currency area, you need to compare different currency pairs and their cyclic situation. So I would not use the US dollar index, but it's similar to that. You should compare the US dollar against different currencies. I mean, Jake shared it against the yen, or the yen against the dollar. I only use it in the Forex markets if I can see alignment of different cycles models in different currency pairs, which in total share the same timing information. So the US dollar versus the euro versus other currencies. And then you can see if there's an alignment. But that's a more complex model of cycle analysis. So you just cannot analyze one currency on its own. You always need to see the cycles in context of other currency pairs. Therefore, maybe I'm sorry to not have a clear answer on this question.
Often the best answer when the signals aren't clear. Thank you, Lars. And from that, I mean, it's an open floor for all our speakers. So maybe one of our top lead questions is just a roundup of what are the top charts, views, and maybe just gold timing that each of you have. So you've already discussed it in depth in your presentations, but just to round it up and kind of synergize between all of you or not. Top views on gold and just general insights. If I can bring in Andy, you led up on top with the price chart. If you could remind us of some of those key setups that you're looking at, just to get the ball rolling.
Yeah, sure, Ron. Yeah, and I think, this is the important thing. I mean, we're here with the Foundation for the Study of Cycles. We're interested in cycles. We're looking at those. But ultimately, when it comes to trading and investing, it's all about risk management. And right now, it's quite simple. We're seeing lower highs and lower lows. The trend is down at this moment in time. And that is the only answer.
And Peter, how does that tie in with some of your bearish cycle views I noticed on the markets?
Yeah, the only reason I have right now to have what could be extremely bearish views in the market, and I didn't show them because we're not concentrating on them. There's a couple of tech stocks, NVIDIA, of course, one of the most active stocks all the time, and one of the big tech stocks. I mean, I have very significantly lower projections on NVIDIA. That has not occurred as yet. Those projections are confirmed. What I'm looking for is confirmation of that kind of move from the NDX. And I was a little disturbed with a bearish view on the NDX when Jake showed his commercials purchasing. But Jake, I have a question for you on that chart. I don't know if you can pull it up again, but on that chart, it showed commercials doing a hell of a lot of buying.
That is
at
correct.
the end of March, which was very bearish. The market, the NDX came down 20% from there in a short period of time.
Well, you have
They
to
were
remember that, Peter, these commercial buyers are in the market for the long term, and most of their activity is based on dollar cost averaging. So it would not be unusual to see the market continuing to go down as they continue to buy.
Okay, so we don't take any short-term positions. based
No,
on that,
no,
right?
strictly not a short-term indicator, but
Okay.
very good point of view.
Yep.
Thank you. And picking on that view, Peter, that you mentioned on deflation, if I could follow up with Bill, you gave a presentation on the view on the economy last time at the FSC summer summit. What's your view from an economic perspective based on your cycles and just general analysis in terms of how the year will end and maybe going out into 2023?
Well, the cycles point down, and I think that is confirmed by the fundamentals that I see. The war on energy, it's making energy more expensive. Of course, the cheaper energy is, the better it is for the economy. And just most of the political programs seem to be anti-free business, and I don't see any relaxation or reduction of that, and the cycles point down. So I think it's confirmed that business activity in the United States will slow down significantly. And as you mentioned, there's an inverted yield, somebody mentioned there's an inverted yield curve, which is negative for the economy and the market. So I think all the signs are there. So I think the cycles are being vindicated here, but in my discussions with people and from what I see, I don't think anybody realizes how serious it is yet.
The really scary thing for me, again, now repeated, is that there are a couple of things that lined up for November of this year, October, November, December, the last quarter of this year, that almost make me think that there could be some, I hate to call it black swan, because then we start talking about fundamentals. I believe that the cycles and the technicals lead to the fundamentals, not vice versa. We're not going to have some kind of world-shaking event and the markets are going to fall apart. I mean, one of the first things I learned about cycles, and I felt that way intuitively, and I think most of you will agree with this, that you can't do stock market timing from fundamentals. You can't wake up early in the morning and say, boy, I can be the first one to read the journal today, or if I can be the first one to see the news today, I'm really going to make a big score in this market. That's complete BS. You don't time markets by knowing even ahead of time what the fundamentals are going to be. Let's go back to some of the most important fundamental events in history, presidential assassinations, whatever. I mean, I'm old enough that I was around when Kennedy was assassinated. It was supposed to be the end of the world. Well, it was a great buying opportunity. So even world wars don't cause markets to go down. What the hell is going to cause them to go down? What fundamental event? So what I'm contending is that there's going to be a black swan event. Its genesis is going to be from the market itself. Something crazy might happen going into the end of this year that's the spark that lights the fundamentals to be drastically lower. Just a wild guess, folks.
And to add to that wild card thinking, Andy, you had some specific kind of timing setups for the end of the year, did you not?
We have some timing setups on gold, but geopolitically, we're seeing some really interesting overlays, as I mentioned before, with the 60-year cycle, which is the 1962 pattern, which did see real extremes in Cold War tension. In fact, it was more than a Cold War tension there. And, as Peter mentioned, the assassination of Kennedy in 63 did create a dip. Well, we're 1 year away from that repeating as well. So, I mean, there are a lot of war cycles that we've covered that previously in previous foundation events. But, what we did see in I think it was October 62, although most of the world was preoccupied with the Cuban Missile Crisis, China and India got into direct active conflict. So that was quite a significant event there as well. And I think that's important. The other thing, although not directly related to what Peter's talking about with regards to a market black swan event, was if we go back to the other part that Peter was talking about, the 90-year cycle, which is one that I look at a lot. We are, of course, approaching the Dust Bowl pattern of 90 years, the depression and the big sort of downturn in the extreme weather patterns. So that is definitely repeating as well off the same basis there. From 1933, 34, 35, we've got huge loss of crops and of course the depression. So those are other factors that I'm just bringing in just from a geopolitical viewpoint based on the 90-year pattern, which I think are pretty important.
Ron, let me emphasize one thing. Even if we do have some kind of crazy event and a huge market decline into end of year, I think it should be emphasized that one of the most consistent cycles in stock market history that's obvious as can be from a long-term chart is the 20-year cycle. 1922 is kind of iffy, but it was a low point in the market that led up to the 29 high. So there's 22, 1942, very important bottom. 1962, very important bottom. 1982, very important bottom. 2002, very important bottom. So where does that lead us? Excuse me, it leads us to 2022. So if we do have some kind of cataclysmic stock market move, we should have some kind of very impressive rally out of a bottom that occurs this year. I personally do not think it'll be the final bottom, but I think it could be a very important.
On that point, we just received an interesting link from one of our audience members. I'll just quickly share a screen. It's a Google search on Black Swan event. And as you can see, there are two big spikes in the last month or so. So clearly our discussion is on the mind of many other people around the world that use this search engine. On that point, we actually have a question that ties in quite well from Praveen, who's recently come across the book Fourth Turning, which has been spoken about for some time now. In each human life cycle, society goes through four major turning events as each generation passes from one phase to the next. Praveen's asking the question, it would be great if the FSC could maybe speak about how cycles fit within human life and so match up into markets every now and again. Open-ended question, but in terms of the link and how it can be relevant.
I think we've covered that certainly in the geopolitical cycles that we looked at earlier this year.
Yeah,
because they are pretty much the same cycles that Strauss and Howe talk about. I would argue for a slightly different time frame on those, which is what I presented. But yeah, it's a very valid book, The Fourth Turning, and human behavior repeats, and I think once you get three generations in the extreme of which is 60 years, you get the extreme events because people, you know, the people that have lived through war will not be around to tell you not to actually live through a physical conflict. And I think that's really what causes it. You know, after 60 years, the wise elders say, you really don't want to go to war. I've lived through it. Don't do it. But of course, they want to prove a point at that point. So, you know, I think, yeah, there's a lot of validity in it. I mean, the 20-year cycle, as Peter says, is a very significant cycle, and it's very prevalent in the commodity markets. And, you know, arguably the 18.6-year cycle that Bill referred to in the real estate cycle, which is also very strong in commodities, is close enough. It's a generational cycle. So there's definitely validity there in commodities and weather patterns, geopolitical behavior, etc. And I think, wasn't there some thesis done about how there was a 20-year pattern in whichever president was elected 20 years apart, there was either an assassination attempt made or a successful assassination. Yeah, I remember reading about that.
I think that failed last time around, but yes, that was a definite.
It did fail last time around, but Reagan was the one before that where he lived through it, and prior to that we got Kennedy, didn't we, and so on. So there's some, you know, degree. I mean, this is an interesting one because that's going to come back around again pretty soon. And well, actually, you know, we're going to see the 60-year cycle from the presidential assassination cycle. It doesn't mean it's going to repeat exactly, but you know, there is a potential threat level on the cycles basis there.
Lars, if I could bring you in at this point, you mentioned right at the end of your session that there are different methods of measuring cycles. To kind of bring it back to Cycles 101. What's your take on that, having kind of experienced the wealth of different frameworks, but also, you know, variations of a view on gold and precious metals? What's your take, and what do you say when you speak with the FSC collective on cycle application and the different ways of applying it?
Yeah, I mean, the lessons to take away is there's not just one method. Yeah, we need to find situations when different methods align. I mean, that's the beauty of cycle analysis, and I think that's what makes the foundation great, that we have different knowledge areas, different colleagues which are experts in their special cycle analysis technique, and no one of us or no individual method will always be right at the time. So I think the goal in this presentation is look out when different cycle analysis methods align in regards to the outcome. And that's why I'm always interested in discussing these topics with you and my colleagues to see this alignment, because there is not just Hurst alone. There's not just static cycles. There's not just dynamic cycles. So, and if they all disagree, skip cycles. Do your technical analysis, or do your risk management, or do your entry and exit management, optimize your exit strategy or whatever. But if you find the points in time when not just one cyclic model, different cyclic models are coming into alignment, then that's the time to act.
A wonderful note to wrap on. Thank you, Lars, and all the other panelists for a enriching conversation on gold and precious metals and everything related to that. We look forward to doing many more of these events into year end and beyond. Thank you for your support, and please keep the questions coming in. We can follow up with our speakers thereafter. Thank you all on behalf of the Foundation Study of Cycles.
Thank you, Ron. You did great.
Thank you.